Let us look at the features of small cap stocks, the characteristics of small cap stocks. They actually present a pathway to high growth investing success. Number one here is significant growth opportunities. Small cap stocks or small cap companies are often in their early stage. They are in their early stages of development. They offer substantial room for expansion. Considering the fact that they are small, they are in the early stage of growth. They present that wider room for expansion. And not only that, they are smaller cap. Their smaller market size, allows for rapid revenue and earning growth compared to mature large cap companies. As you all know, in real life, it's very easy to convert $1 to $2 or $3 or $4, but it's difficult to convert $1 billion to 2 billion to 3 or to $4 billion. It's difficult. It's virtually impossible. And so the larger the size, the more nimble an investment becomes. That is it. And so with the smaller cap companies, it's very easy for you to double and even quadruple your money, your investment. That's what you cannot do with a large cap company. And so there's that significant growth opportunities. They have, a high level of growth potentials. Number two is market inefficiencies. When we talk about market inefficiencies, small caps are less covered by analysts. And this leads to potential undervaluation. What generally drives stock prices is that discovery of value. When analysts, focus on a stock, they analyze, they research, and they bring out recommendations as regards the company's prospect. These recommendations, either positive or negative, will certainly impact the stock price. If it is positive, the stock price will tend to rise. If it is negative, the stock price will then tend to drop. So these are small cap companies lack the attention of analysts. Very few analysts follows them. And for that reason, they are not actually discovered. Their values are not actually being discovered. And for that reason, they remain undervalued. And so investors can capitalize on these inefficiencies by identifying overlooked, ignored, neglected growth opportunities in small cap stocks. Because of their lower analyst following, as an individual investor, you can carry out a personal research and discover that yes, these stocks are undervalued. You could key into those opportunities, buying at a lower price, and you will eventually sell at a huge profit. Number three is higher potential returns. Small cap stocks are known for higher potential returns. So historical data reveals that small cap stocks have delivered higher returns over the long term compared to mid cap and large cap stocks, driven by the capacity for for faster growth. They have that inherent capacity for growth, for faster growth. That is why they possess this higher level of returns. Number 4 is acquisition targets. They are often targets of acquisition. Bigger companies will want to acquire smaller companies. And so small cap companies often attract acquisition interest from larger firms seeking to expand their market shares, leading to potential price surge upon takeover announcement. So many big companies, instead of starting something new from scratch, will want to buy these emerging small cap companies. And once the announcement is made that a particular company is going to be acquired, almost automatically the company's price will then rise. The company's share price will skyrocket based on the announcement. And if and when the merger eventually takes place, you discover that the price will even, might even climb higher. Another important feature here is number 6, diversification benefits. Diversification benefits. So including small cap stock in your portfolio provides diversification by balancing exposure across different company sizes, sectors, growth stages, and by so doing you are reducing dependency on large cap performance. It's good you have large cap, but try to diversify by including small cap stocks in your portfolio, as the large cap stocks are providing stability, liquidity, steady growth. The small caps are bringing in, higher growth potentials. They are bringing in outsized growth potentials, and this will give you a better performance in your portfolio compared to if you only, invest in large caps, large cap stocks. So you have an improved level of performance. Number 6 is innovation and niche market focus. Innovation and niche market focus. You discover that small cap firms tend to be more agile. They are more agile, just like comparing a fighter plane, a jet fighter plane, to a jumbo aircraft, to a large aircraft. You discover that the fighter plane is nimble, is faster because of the size. It's more agile, can execute maneuvers, and so they tend to be, more agile. They are more innovative as emerging companies, and they tend to focus on the smaller niche markets, enabling them to adapt quickly to market changes and capitalize on emerging trend. Because they are agile, they are nimble, they are more sensitive to the market environment, and they can adjust quickly to trends, to emerging trends in the economy. And so while small cap stocks offer high growth potential, they come with increased volatility and risk. We should not forget that they are highly volatile and they could be risky. So making them suitable for investors with higher risk tolerance and long-term investment horizon. You want to invest for the long run, all right, holding your stocks for years, and at the same time you want, a higher than normal growth level, then you could or you should include small cap stocks in your portfolio. That will give you the kind of returns you would want to achieve as an investor. But mind you, you should be willing to bear the risk. If you have the risk tolerance, you can go ahead and invest in smaller capitalization companies.